Ever felt like you need a map to figure out motor insurance in India? All the rules, the jargon, it can get pretty confusing, right? Well, what if we could clear all that up in just a few minutes? Let's dive in and really break down this essential shield every vehicle owner needs.
So, here's the plan. We're going to start with the law itself. Then we'll decode what's actually in your policy. After that, we'll walk through the all-important claims process, touch on the tough stuff like disputes and fraud, and then, this is the cool part, we'll peek into the future to see how tech is changing the game.
Okay, so first things first. To really get motor insurance, you have to start with the law. I mean, it's the foundation everything else is built on. So why is it compulsory? Why do you legally have to have it?
Believe it or not, this whole thing started way back in 1939. But, as India's roads got way busier, that old law just couldn't keep up. By 1984, it was clear they needed a major update, which led to the Motor Vehicles Act of 1988. That's the law we live by today, and it officially kicked in back in 1989.
At the absolute heart of this law is one thing: third-party insurance. Now, it might sound a little technical, but it's actually super simple. Think of it like this. The first party is you. The second party is your insurance company. And the third party? Well, that's literally everyone else. Another driver, a pedestrian, the owner of a wall you might hit. This insurance protects you from having to pay for their damages.
So let's talk numbers. What if you damage someone's property, like their car or a gate? Well, your basic third-party policy has you covered up to this amount, 7,50,000 rupees. That's the maximum payout for property damage in a single accident.
But, and this is a huge but, when it comes to injuring a person or worse, everything changes. The law is crystal clear on this one. Your liability is unlimited. A court decides the compensation, and your insurance has to cover it. All of it. No cap. This is the ultimate financial safety net the law provides for victims on the road.
Okay, so you have to have insurance. But what are you actually buying? What do all those terms in the policy document really mean? Let's pull it apart and decode it.
You've basically got two main choices. On one side, you have the liability-only policy. This is the bare-bones legal minimum. It covers your responsibility to others, but, and this is key, it does absolutely nothing for your own car. On the other side is the package policy, which most of us call a comprehensive policy. It's got the mandatory third-party cover, plus it protects your own vehicle from damage, theft, fire, you name it.
Now, if you go for that package policy, the most important number you'll see is the IDV, or Insured's Declared Value. Just think of it as the maximum payout for your vehicle. If your car gets stolen or is a total wreck, the IDV is the biggest check you're going to get. It's not the resale value, it's a specific formula based on the car's original price and how old it is.
So how do they get that IDV number? It's not just a guess. It's all based on this official chart. The insurance company takes the manufacturer's current price for your car model and just subtracts a percentage based on its age. So you can see, if your car is, say, a little over 2 years old, they'll knock 30% off the selling price to get your IDV.
Here's a cool little inside-the-industry secret that actually helps you out: the knock-for-knock agreement. Instead of insurance companies suing each other to figure out who's at fault after an accident, they just don't. The agreement says, my insurance will pay for my car's damage, and your insurance will pay for yours, regardless of who caused it. This cuts out the lawyers and the long waits, getting your car fixed way faster.
All right, now for the part that really matters, making a claim. This is the moment of truth, right? It's when that policy document turns from just paper into a real financial shield.
The whole process, even though it can feel overwhelming, really boils down to 3 steps. Step 1, intimation. This just means you have to tell your insurer right away. Don't wait. And if it's theft or someone's hurt, you call the police too immediately. Step 2, survey. The insurer sends out an expert, a surveyor, to check out the damage and estimate the cost. And finally, step 3, settlement. That's when the insurance company pays the bill.
Now, about that survey step, there's an important rule to know. If the damage to your own vehicle is estimated to be more than 50,000 rupees, the law says the insurance company has to bring in a licensed independent surveyor. It's a way to make sure the assessment on bigger claims is fair and unbiased.
So, have you ever wondered why the insurance payout sometimes doesn't cover the full repair bill? Well, a big reason is depreciation on parts. The idea is that insurance is meant to put you back where you were, not give you brand new parts for old ones. So for things like rubber and plastic parts, you have to chip in 50% of the cost. The one cool exception? Glass. There's no depreciation on glass parts.
But of course, things don't always go smoothly.
Let's talk about the tougher side of insurance. What happens when there are disputes and the really big problem of fraud.
And yeah, fraud is a massive issue, and it ends up costing everyone more in premiums. It can be anything from faking an entire accident to just getting a repair shop to pad the bill. One of the most common scams, though, is when someone tries to buy a policy after their car is already damaged or stolen, just to try and make a claim.
So how do the insurance companies fight this? Well, one of their main weapons is a physical inspection. If you let your policy expire, even for a single day, and then you want to get a new one, they'll almost always want to see the car in person first. This break-in insurance check is their way of making sure they're not about to insure a car that's already a wreck.
Okay, let's shift gears and look down the road a bit. Technology is about to completely shake up the world of driving, and that means the entire motor insurance industry is in for a massive change.
Just think about this for a second. Google's early self-driving cars went over 300,000 miles without a single crash while the computer was in charge. Why is that such a game changer? Because almost all accidents are caused by us, by human error. If you take the human out of the driver's seat, you change the entire risk of being on the road.
But even before our cars drive themselves completely, technology is already changing the rules. The old way of setting your premium based on big general statistics is on its way out. The new model is way more personal. It's all about your own driving data.
And this tech revolution is happening in a few ways. You've got pay-as-you-drive, which is simple. The less you drive, the less you pay. Then there's telematics, which is a bit more advanced. It uses a device to track how you drive, your speed, how hard you brake, to figure out how risky you are. And the real future stuff? Vehicle-to-vehicle tech, or cars actually talk to each other to avoid crashes before they happen.
So where is all this heading? We are right on the edge of a massive shift. This technology promises more than just safer roads. It makes us question who's even responsible when things go wrong. And it leaves us with this one giant question. As cars get smarter and smarter, could the accidents that have defined driving for 100 years one day just disappear?